Well, most global equity markets certainly enjoyed strong gains in the first quarter of this year, largely accompanying fading perceptions of systemic risk, and particularly with the European Central Bank stepping up quite aggressively its liquidity operations, and that seemed to avert the risk of a major financial accident in Europe. At the same time, of course, we also started to see signs that perhaps the US economy had weathered a number of shocks earlier in this year, and that growth was also starting to pick up there. I think after those strong gains, it's not surprising that markets have paused, and certainly in a lot of markets, pricing was becoming a little bit frothy. But the more recent weakness has also accompanied growing investor focus on the structural issues in Europe that haven't been addressed, that the European Central Bank's liquidity programs really only glossed over. More recently, of course, we've seen a big renewed rise in Spanish bond yields. We've seen adverse outcomes from the Greek and French elections, to the extent that it's raised investor fears that there may be some backsliding now on earlier political agreements. Well, clearly the ongoing problems in Europe remain major downside risks to global growth, which is still struggling in the face of private sector deleveraging and intensifying fiscal consolidation right across the globe. In the European region, recent data has confirmed market suspicions that the recession there may be perhaps a little bit deeper and more protracted than thought perhaps only 3 months or so ago. In the United States, we've seen signs that some of the earlier pickup in the labour market and in payrolls growth may have started to fade a little bit more recently. And in the US, it's really dispelled any hopes that US GDP growth can track up above 2%. In China, there's also been quite a sharp slowdown in growth, but inflation there is still proving quite sticky, and that's preventing the authorities from more aggressively easing monetary policy and fiscal policy. So while you have these divergences in growth right across the globe, it's very difficult to see an early return to more synchronised growth. And until that occurs, we think the global recovery will remain fragile, it will remain sub-trend, and it will remain vulnerable to both growth and policy disappointments. Against this broader backdrop, we think financial markets are likely to remain volatile, sensitive to growth and policy disappointments, but with central banks standing ready to intervene and step up asset purchase programs if necessary. We think that in this sort of environment, investors should be retaining a broadly neutral allocation to risk assets. Valuations in this environment become very important. We're advocating investors seek out quality assets that can provide a cushion against growth and earnings disappointments, but at the same time without sacrificing longer-term return potential. In equities, this would lead us to favour quality sectors where earnings growth is sustainable and where traditional premiums above lower quality sectors perhaps aren't as quite as high as you might expect in this sort of environment. In fixed interest markets, it's almost completely the reverse. AAA rated or otherwise high quality sovereign bond markets are the ones that seem to be most fully valued. Where yields are at the moment, it's very difficult to see any sort of real returns out of sovereign bond markets over the next few years. It's the lower quality sectors in fixed interest, such as investment grade, high yield credit, emerging market debt, where we feel there's a little bit more relative value at the moment. We continue to retain an attractive rating on global emerging market equities. Despite the strong rally earlier this year, valuations still appear quite reasonable. On a forward price earnings basis, emerging markets are trading at a significant discount to the developed markets, but nothing out of line with long-term averages. And given the superior macroeconomic fundamentals, long-term earnings story, we think there's a case that perhaps those discounts might actually be narrower than they should be at present. However, this is a very high beta, volatile asset class. Investors need to be comfortable with that volatility. There's a case, we think, that perhaps to fund an overweight position in emerging markets, investors might want to consider underweight positions in other similarly volatile equity asset classes such as global small caps or even to some extent global listed property.